A dividend portfolio can pay you every single month for doing absolutely nothing. No trades, no timing, just cash hitting your account while you sleep. But most beginners screw this up immediately. They chase the highest yields, pick stocks that look safe, and wonder why their income vanishes when the market dips. Here's how to actually build one that lasts. Forget everything you think you know about dividends. The biggest myth is that high yield equals good investment. You see a stock paying 8% annually and think you've struck gold. Meanwhile, the company's bleeding cash, the dividend gets slashed, and your income disappears along with 40% of your principal. Real dividend investing isn't about grabbing the fattest yield. It's about building a machine that pays you reliably, grows over time, and doesn't explode when the economy hiccups. Start with this. Your dividend portfolio needs 3 layers: stability, growth, and yield. Stability keeps you sane during crashes. Growth ensures your income rises faster than inflation. Yield gives you cash now. Most people pick one and ignore the other two. That's how you end up with either no income, no growth, or no portfolio when things get rough. Layer 1 is your foundation. These are companies so boring they make watching paint dry seem thrilling. Utilities, consumer staples, healthcare, the stocks nobody brags about at parties. Johnson & Johnson, Procter & Gamble, Coca-Cola. They've paid dividends for decades, sometimes over a century. Why? Because people need bandages, toothpaste, and soda whether the market's up or tanking. You're not buying these for excitement. You're buying them because they won't disappear. But here's the thing most guides won't tell you. Stability doesn't mean safety. A stable company can still be overpriced. Coca-Cola might be dependable, but if you pay 40 times earnings during a market frenzy, you're going to sit underwater for years, waiting just to break even. Price matters. Always. You want these stocks when they're reasonably valued, not when everyone suddenly remembers dividends exist during a crash. Layer 2 is growth. This is where your income actually compounds. These companies increase their dividends every single year. Not by pennies, by meaningful percentages. Visa, Microsoft, Home Depot, they're not paying you 6% right now, maybe just 2% or 3%. But that dividend grows by 10% or 15% annually. In 10 years, your yield on cost, what you're earning relative to what you originally paid, could be 8% or higher. That's the difference between earning the same $500 a year forever and watching it climb to $1,200 without adding another dollar. The magic of dividend growth is invisible at first. You buy a stock yielding 2.5% and think you've made a mistake compared to the one paying 5%. 5 years later, your 2.5% stock is paying you more per share than the 5% stock because it kept raising the payout while the other one stayed flat. Patience isn't optional here. It's the entire strategy. Now comes the yield layer. This is what everyone wants immediately. Monthly or quarterly cash you can actually spend. Real estate investment trusts, or REITs, are the go-to here. Realty income, VICI properties. They're required by law to pay out 90% of their income as dividends, which means yields often sit between 4% and 6%. You're not getting much growth, but you're getting consistent income. Same goes for certain energy infrastructure stocks and some preferred shares. But there's a trap. High-yield investments are sensitive to interest rates. When rates climb, these stocks often drop because bonds start looking more attractive. You need to know what you're buying and why. A rate paying 5% is great if the properties are solid and the tenant base is diversified. It's a disaster if they're over-leveraged and one recession away from cutting the dividend in half. So how do you actually put this together? Start with allocation. If you're young and decades from needing the income, lean heavy into growth, maybe 60% growth. 30% stability, 10% yield. If you're closer to retirement or want income now, flip it. More stability and yield, less growth. There's no perfect formula. It depends on your timeline and how much cash you actually need. Then comes the hard part. Most people want to build this portfolio in a week. Buy 10 stocks. Call it done. That's not how this works. You're looking for opportunities. A solid dividend grower pulls back 15% for no fundamental reason? That's your entry. A stable giant drops because of short-term noise? Add it. You're not racing to finish. You're building something that'll pay you for the next 30 years. And here's what nobody mentions. The first year is brutal psychologically. You'll watch your portfolio move up and down while your dividend income trickles in at maybe $50 or $100 a quarter. It feels pointless, like you're doing all this work for lunch money. But that's the test, because in year 5, that lunch money becomes rent money. In year 10, it's a salary. The people who quit in year 1 never see year 10. The real question isn't whether dividend investing works, it's whether you'll stick with it long enough to find out. And that starts with understanding what you're actually building, not just chasing the next 7% yield that looks too good to be true. The collapse didn't announce itself with sirens. It crept in through the back door while everyone was still counting their paper millions. 1929 wasn't just a market crash, it was the moment an entire generation learned that wealth on paper burns faster than actual paper. Stocks had become America's new religion, and everyone from shoeshine boys to bank executives had converted. The Dow had tripled in 5 years. Margin loans, where you borrowed 90% to buy stocks, were as common as mortgages. Nobody asked what happens when the music stops because the music never stops, until it does. September 1929, cracks started showing. A few investors got nervous, sold positions, took profits. Nothing dramatic, just subtle pressure. Then October hit. Small sell-offs turned into panic. October 24th, Black Thursday, the market dropped 11%. Bankers pooled money, bought stocks publicly, tried to calm everyone down. It worked for about 3 days. October 29th, Black Tuesday, the floor collapsed entirely. 16 million shares traded hands. The system couldn't even keep up. Ticker machines ran hours behind, meaning people were selling blind, guessing at prices, drowning in real time without knowing how deep the water was. Fortunes evaporated before lunch. Speculators who'd bought on margin got wiped out instantly. You borrowed $90 to control $100 worth of stock. It drops to $50. You don't just lose your $10, you owe $40 you don't have. Suicides followed, though not as many as legend claims. What actually happened was worse. Millions of ordinary people, the ones who believed this time was different, watched their savings disappear into nothing. The mechanic who put his kid's college fund into radio stocks, the teacher who bought utilities on margin, the retiree who trusted his broker's hot tip. Gone. Banks were next. They'd loaned heavily against stocks as collateral. When stocks collapsed, the collateral became worthless. Depositors panicked and rushed to withdraw everything. Banks didn't keep everyone's cash in a vault. They lent it out. When everyone wants their money simultaneously, the math doesn't work. Over 9,000 banks failed in the next few years. Entire communities lost everything overnight. Your life savings weren't insured. If your bank went under, you got nothing. The ripple effects were immediate. Businesses couldn't get loans. Factories cut production. Workers got laid off. Those workers stopped spending. More businesses failed, more layoffs. The spiral fed itself. By 1933, unemployment hit 25%, 1 in 4. Not seasonal joblessness, not between gigs. Actual, crushing, no prospects unemployment. Breadlines stretched blocks. Families lost homes. Hoovervilles, shanty towns made of scrap metal and cardboard, popped up in every major city. People named them after President Hoover, who insisted the economy would fix itself and government intervention would make things worse. It got worse anyway. The Dust Bowl hit next. Years of overfarming and drought turned the Great Plains into a desert. Massive dust storms, some over a mile high, blacked out the sun. Crops died. Livestock suffocated. Families packed everything into jalopies and headed west, chasing rumors of work in California. Most found nothing but more poverty and resentment. Entire communities disappeared. The American heartland became a graveyard. Meanwhile, the wealthy who'd gotten out early or never played the game watched from a distance. Some lost fortunes, others barely noticed. The stock market crash hurt speculators. The depression crushed everyone else. That's the part people forget. The market recovered eventually. The lives didn't. What actually ended the depression wasn't policy, it was war. Europe descended into chaos. Hitler rose. Japan expanded. By 1939, the world was burning, and America started producing weapons, planes, ships. Factories that had sat idle for years roared back to life. Unemployment dropped not because the economy healed, but because millions of men shipped overseas and millions more built the machines that kept them alive. The stock market, the thing that started it all, became irrelevant. People stopped trusting it. An entire generation swore off stocks entirely, kept cash under mattresses, bought bonds if they bought anything. It took decades before Americans believed again, and when they finally did, when the market roared back in the 50s and 60s, it was a different crowd. The ones who lived through 1929 never forgot. Here's what matters now. The crash didn't happen because stocks are inherently dangerous. It happened because people forgot risk exists. They leveraged everything on the belief that prices only go up. They bought things they didn't understand with money they didn't have. And when reality arrived, it arrived fast. Dividend investing doesn't prevent crashes. Nothing does. But it changes what a crash means. If you own stocks purely for price appreciation, a 50% drop destroys you. If you own them for income, the dividend doesn't care what the price does. Coca-Cola paid dividends through the Depression. Procter & Gamble kept paying. The stock prices collapsed, but the checks kept coming. That's the difference between investing and speculating. Speculators need the price to go up. Investors need the business to keep running. The market will panic again. It always does. What it won't do is destroy companies that actually make things people need. The 1929 crash taught us something brutal. Speculation ends. Business continues. So what do you do with that? First, stop thinking the market owes you anything. It doesn't. It's not designed to make you rich. It's designed to transfer capital from impatient people to patient ones. Every bubble, every crash, every panic is the same lesson taught to a new generation. The price you pay determines everything. Overpay for anything, even a great company, and you'll regret it. Buy Coca-Cola at 100 times earnings in 1929, and you're broke by 1932, even though Coke kept selling soda. Buy it at reasonable prices and reinvest the dividends, and you survive. Thrive even. That's not luck. That's math. Second, income matters more than you think. Price fluctuations are psychological. Dividends are contractual. One is a feeling, the other is a deposit. When the market crashes, and it will, the only thing that keeps you sane is cash flow, not potential cash flow, not projected growth. Actual money hitting your account while everyone else panics. That's not just financial, it's emotional survival. Because the hardest part of a crash isn't losing money. It's watching everyone else lose their minds and resisting the urge to join them. Third, understand what you own. The 1929 crowd bought anything with a ticker symbol. They didn't know what the companies did, didn't care. The stock went up yesterday, so it'll go up tomorrow. That's not investing, that's gambling with extra steps. If you can't explain what a company does, how it makes money, and why it'll still be doing that in 10 years, you don't own an investment. You own a lottery ticket, and the house always wins eventually. Fourth, leverage is a trap. Buying on margin in the 20s wasn't some fringe strategy. It was standard. Put down 10%, borrow 90%, write it up, pay it back, keep the profit. Worked perfectly until it didn't. Then people lost everything, including money they never had. Debt amplifies gains, sure, but it amplifies losses faster. And when the market crashes, your broker doesn't care about your situation. They want their money now. You either have it or you don't. There's no third option. Fifth, diversification isn't just owning a bunch of stocks. It's owning a bunch of income streams. 10 stocks in 10 sectors sounds diversified until they all cut dividends in the same recession. Real diversification means different businesses, different industries, different economic exposures. Some that thrive in downturns, some that survive anything, some that grow when everyone else stalls. You're not building a portfolio, you're building a system that pays you regardless of what the market does. Sixth, time is the only edge you have. The professionals have better data, faster execution, smarter algorithms. You can't outpace them, but you can outweight them. They're measured quarterly. You're measured never, unless you choose to be. That's the advantage. You can hold through crashes they're forced to sell through. You can collect dividends they have to ignore because their mandate says growth only. You can be boring and patient while they chase performance. And over decades, boring wins. Seventh, the market will try to shake you out. It always does. Some crash will come that feels different, bigger, unfixable. The news will say it's over. Experts will recommend cash. Your neighbor will brag about selling everything at the top. And you'll wonder if you're the idiot for holding. That's the test. Not whether you can pick stocks. Whether you can sit still when sitting still feels like the wrong move. Because the ones who sold in 1932 missed the recovery. The ones who sold in 2009 missed the next decade. The ones who sell in the next crash will miss whatever comes after. The pattern never changes. Eighth, know when to do nothing. The best investors aren't the ones who act the most. They're the ones who act the least. They buy quality, collect income, and let time do the work. No trades, no timing, no cleverness, just patience. The 1929 crash didn't punish people for owning stocks. It punished them for treating stocks like poker chips. The Depression didn't destroy businesses, it destroyed speculation. If you own actual companies that make actual products people actually need, crashes are just noise. Loud, terrifying noise. But noise, the dividend keeps coming, the business keeps running. And eventually the market remembers that price and value aren't the same thing. That's the real lesson from 1929. The market will lose its mind. You don't have to. So build the portfolio, layer it right, buy when prices make sense, not when everyone else is buying. Reinvest the dividends when you don't need the cash. And when the next crash comes, because it will, you'll have something most people don't. Income that doesn't care what the market's doing. That's not theory, that's survival. And decades from now, when everyone's panicking about whatever disaster comes next, you'll be collecting checks like nothing happened. Because for you, nothing did.